Welcome back. Well, we've already heard that the future for retail investors is largely involving SMSFs, so self-managed super funds. I'm sure you all know that. They are already growing in popularity, but still, most are not exactly DIY. So let's talk tech and what makes the ultimate SMSF stack. And for that, we have Doug Morris, who's joining us from Sharesight, and also Andy Rogers from CMC Market Stockbroking. Welcome back, guys. What exactly are we talking about here, Doug?
So SMSF tech stack, yeah, that's kind of a, I don't know if we at Sharesight developed the phrase, but we sort of borrowed it or where it came from. But really what that means is sort of optionality for SMSF trustees. So you no longer need to go with kind of a full service, vertically integrated bank for SMSF execution and compliance and reporting. There are now technology options out there that you can use, and you can actually sync up together to sort of amalgamate your own solution. Okay,
so is this specifically designed for new entrants into SMSFs? We've got a lot of younger demographic, I've got to say. You can notice them being targeted by different groups in terms of building their own self-managed super fund. So yeah, who are we talking about? Just new entrants, or you can sort of reverse engineer it?
It's quite interesting, actually. I think originally the intention was more for the experienced, really hands-on, self-directed investor who kind of understood the costs that were kind of baked into the traditional model. But because it's technology, it tends to attract younger, mobile-first investors as well. So there's always that bit of a paradox between something that can be designed for the kind of original audience and then the people who kind of flock to it as well. So yeah, I mean, you can find these solutions online on your phone, and younger millennial type investors will certainly find them as well.
Okay, so Andy, do you see a demand for SMSF products through your client base?
I mean, since 1997, we've been establishing SMSF broking accounts. So we've got, hundreds of thousands of them, literally. Certainly, in terms of back in the day, the SMSF lent more towards someone with a higher value portfolio, because the higher the value of your portfolio, the more the economics make sense. But with technology and some of these niche service providers that can offer different pieces of what you need, then the portfolio value has come right down. We've got partners who use our platform who also do the SMSF admin piece. And they can, one of them, you can establish an SMSF and do the annual administration of compliance and lodgement for just over $1,000, I think. So the cost has come right down. Again, the bits with an SMSF, because it is a bit of responsibility. It's not put it in an industry super or corporate super and you don't have to worry. So you do have to get involved, but you do get the benefits. Particularly as over time, an SMSF, in general, as you're contributing it throughout your working life, if you're at that stage, it's only getting bigger and bigger in terms of your pool of money. So the actual benefits you reap on an ongoing basis. Yeah. But certainly, the Sharesight solution and how much power that has for an SMSF trustee is really useful.
Okay, so let me better understand then, what exactly are we talking about? If I had my own SMSF and I was going to develop my own tech stack, what am I looking at?
So fundamentally what you're looking at is a place to do trade execution. So you need a broker, and then you can seek out a broker like CMC or a low-cost broker or a traditional broker, or even mix and match like a low-cost broker and a full-service broker for some ideas.
Okay.
You're also talking about the accounting fees associated with producing the annual accounts and the audit for the SMSF.
But it still has to be audited.
Still has to be audited.
Okay.
Yeah. And again, there are low-cost online first auditors available out there as well that you can use.
Okay.
Maybe you're talking about a bit of investment research. So where do you get that? Are you going to go to a Motley Fool or a Morningstar or somewhere independent like that for a few $100 a year? You can do that. But really what you're also talking about, though, is removing kind of the platform asset-based fees and removing the administration fees regarding having your portfolio sit on an old school platform that's taking an asset-based fee, regardless in most cases of performance. And that's money that's kind of leaving the portfolio that you're not able to then reinvest, and it doesn't compound over time. So those are kind of the main building blocks that we're talking about.
Okay, so how much money are we talking about saving? You must
Sure.
have done the numbers.
So we've done some analysis on this. It's on our blog. If you assume a $500,000 SMSF invested in shares and ETFs, I'm not talking about property, which is a whole other SMSF topic.
We don't have time for that today. Though.
Yeah, nor am I an expert. But if you're talking about a $500,000 portfolio, if you're going to go the old school route, which is kind of hand it to one of the bank-owned platforms or one of the other independent platforms that become much larger as a result of the banks exiting wealth, we're talking about $9,000 to $10,000 a year, all up in costs and fees. Now, you'll never see that. It won't be itemized for you. It's all baked into asset-based fees and admin fees and boring bits that's like way back at the PDS somewhere. If you're moving towards a more DIY, kind of building up your own SMSF solution, you can bring that fee down to $4,000 or $5,000 a year, which again, if you think about it in terms of your return, you're basically having your return that you're reinvesting each year if you're going with kind of the old school option. But it requires time and attention and effort to do it yourself. It does.
Okay, time, attention, effort. So say I'm into that.
Sure.
Because I enjoy it.
Sure.
What are the other risks?
Well, the other risks are that you're basically acting as your own household portfolio manager. So you're certainly taking the risk in terms of the investment decisions you make, right?
Yeah.
So all of a sudden, there's a lot of pressure when you get your own SMSF. And I've only had one myself for since I was an Australian citizen, which has only been a couple of years, because I couldn't otherwise. But there's a burden that sort of shifts onto me as the PM that even though I've spent my career in investing, it's like, I better know what I'm doing.
Yeah, this is real.
Yeah, exactly.
So you're talking about it being attractive to potentially a younger demographic, but you could be at the later phase of your journey, and you can still sort of unpick these things quite easily. What would be the barriers to doing that?
So, I mean, in terms of the broking solution, if you for an SMSF, the majority will, and certainly on our clients, we are on a HIN-based model. So you can always port your account to another broker, to a full service broker if you get too old and you really can't be bothered to manage it anymore, or you can send the stock to issue a sponsored. It's really your choice. So you keep full control. You're really broker agnostic, even though the majority, if it's working, the admin's set up, that they stay generally with one broker. You look for a provider that sends data to the administration companies who work in this eco chain. So we allow clients to have a Macquarie account, which is one of the most integrated accounts, the Macquarie CMA for an SMSF, because they feed data to some of these downstream vendors. We as a broker also send data at the client's request with all the privacy obligations, etc. So we make life as easy as we can. That's the kind of our piece of it, and obviously we do the platform, the execution as what we do.
So say somebody out there is watching right now, Doug, and they think, oh yeah, okay, I'm up for it. I'd like to manage my own SMSF, get this tech stack going for me. How long does it take? Because of course, it requires work to change all these things as well, doesn't it?
It does. And I think reading the fine print around moving your assets, if they're on a platform, out of that in terms of exit fees and break fees and all that is definitely worth understanding. Definitely, especially if you're an older investor approaching retirement and that balance is significant. It might be a percentage of your assets. So that's certainly one area to look at very carefully. The other is just the pain of changing accountants, which we've all had to do. And that may be something you need to do as well, because your accountant may be sort of in partnership with an advisor who's using that investment platform. So finding an accountant who is, I would say, more digital, who perhaps is using Xero for accounting, is a real big step in the right direction, because then all the data is on the cloud, it's accessible to you. You can hook that into things like Sharesight, which is hooks into CMC. So all these things begin talking to each other.
Okay.
But those are the two kind of biggies: accounting, pain, and the fees associated with exiting wraps and platforms.
Got it. All right. Well, that's a little look into what could be an ultimate tech stack. We'll take another short break. Up next is DIY all or nothing. So can a happy medium be found to maximize profits and minimize risks? We will welcome back to the studio Pat Garrett from Six Park in just a moment. We'll be back.